Our next guest scored a New York Times bestseller with his book, The Great Depression Ahead, saying government stimulus would not save the economy. Now he's out with a follow-up. It is The Great Crash Ahead. He's Harry Dent. Harry, welcome. We're glad you're joining us from Tampa, but I got to ask you, why are you so gloomy? It's the holiday season.
Well, you know, Adam, we actually, short-term, we've been predicting a Santa Claus rally, as is very typical. And we've been bullish for 20 years because we've been tracking the baby boomers moving in increasing numbers into their peak spending, earning, and borrowing years, which pretty much we hit that crescendo in late 2007. Now we're in what we call a plateau phase, moving sideways as their kids get fully out of school. From about 2012 on, we see demographic pressures getting more heavy on the economy. It's that simple. When baby boomers were borrowing and spending, everything's fine. When they're not, stimulus doesn't work as well because these people don't need a bigger house. When the kids leave the nest, you don't drive your car as much. You downsize your house, if anything, and people spend less into death from age 50. So it's just demographics from our point of view.
So if I'm hearing you correctly, the problem is not necessarily that we have too much debt. It's that our population isn't growing fast enough to find new people who are going to go out and buy stuff. Is that right?
Yeah, we cannot grow our way out of this, as people say. You get these major demographic slowdowns once a generation, about every 40 years. We saw it in the 1930s for 12 to 14 years. We saw it in the 1970s into the early 80s, and of course Japan in the 90s and early 2000s. So this is a natural cycle. Now, it is also true that we have way too much debt. People look at the public debt at, $15 trillion. They don't understand that at the top of this bubble, we had $42 trillion in private debt, and that debt went from 20 to 42 in 8 years when the government debt went 5 to 10. So we have a giant private debt crisis in our banking system, consumer borrowing and mortgages, and corporate lending, and that is what was starting to melt down. The demographics is the trigger, but having that much debt is what causes a meltdown in the banking system, as we saw in 2008, early 2009, and that's what required such massive stimulus. But you can't fight 42 trillion in debt deleveraging, and you can't fight 92 million baby boomers who now want to save for retirement instead of spend.
Hey, where is debt the worst? Is it at the banking level, the personal level, the municipal level, the federal level? Where is debt the worst?
Well, at the top, the worst, we had $17 trillion alone just in the financial sector. This is Fannie Mae, Freddie Mac, Wall Street, toxic mortgage funds, and all this stuff. This has never been done before. Banks actually borrow to lend or sell off their mortgage loans and divest from that. That's a terrible thing. It's never happened in history. Consumer debt at the top was $14 trillion. That is twice as high as it was in the roaring 20s boom at the worst when you compare it to income and GDP. And corporate debt was $11 trillion. So again, everybody's looking at the public debt, which is going to rise in a slowdown here. But nobody's seeing how much private debt we have, and nobody's also seeing there's a huge opportunity. If we write down this debt like we did in the 1930s, we could save $20 trillion in debt long-term for consumers and businesses and take a huge load off their backs right at a time when demographics say, look, otherwise our economy is going to slow.
All right, that may or may not happen, but bottom line, people do have money. They got to put it somewhere. What do you tell people to do with their money right now?
Well, for the most conservative investors, you'd be in the safest short-term bonds, T-bills, something like that. For people a little more moderate, what we note and point out, and nobody gets this, the U.S. dollar was one of the few things that went up in the last meltdown. Everybody thinks gold and silver is going to save you, but in that last meltdown in late 2008, gold and silver went down, oil crashed, everything else went down, U.S. dollar and Treasury bonds went up.
And
Treasury
why?
Bonds, there's already been a flight, huh?
Why?
But because you're deleveraging debt and you're destroying a lot of the dollars you created. We created $42 trillion in private debt. That is creating dollars. We debased our dollar in the boom. A downturn like this will destroy a lot of dollars in debt, just like it did in the 1930s, and you will get deflation in prices instead of inflation. That means gold and silver go down, the U.S. dollar goes up. U.S. dollar was up almost 30% in late 2008 when everything else was down. So moderate investors, you can do UUP. It's an ETF that tracks the U.S. dollar index as a hedge against things going down. And for aggressive investors, bet on things like stocks and gold going down. Bet on stocks going down, SH. That's a bet on the S&P 500 going down. DGZ is a bet on gold going down.
All right, Harry Dent, we appreciate your coming on and joining us. Here's the book. It is The Great Crash Ahead. You're a New York Times bestselling author. We also appreciate the picks and what to do with your money. Harry, have a good holiday weekend. Thanks for joining us.